When a business posts strong growth and the market recoils, it's usually a positive. The market can get tunnel focus sometimes on a certain metric for a business. Any deviation from Wall Street expectations for that metric, and they punish the business hard. Fundamentals are ignored because of short-term emotions. This is why patience is a virtue on the quality investor. Because if a business is sound, there's no reason to worry. In the long term, growth is rewarded. Welcome to the Quality Investor. Cybersecurity stock Fortinet, ticker FTNT, just posted blowout earnings. They beat on revenue and had a huge beat on earnings per share of over 40%. And there was a lot to like about this quarter. Fortinet provides security solutions, primarily in the cybersecurity hardware market. This market has been in a downturn recently as IT departments have shifted spend away from on-prem infrastructure to more cloud-based solutions. This spooked investors last quarter as billings, the metric that investors love, fell 6.4%. This sent the stock tumbling and many questioned Fortinet's future. But before we get into it, please like this video and subscribe to the channel. It only takes a second, helps us grow, and you can stay on top of all the quality businesses in the market. However, while the street was panicking, I demonstrated where the future strength was for Fortinet. I argued that their shift to the services segment is where the value is. The services segment is predominantly software, high margin software for the cybersecurity cloud market. Their growth in that segment is far outpacing the product segment, and that is offering a big boost to margins as I showed in that video. The product segment gross margin is nearly 61%. Not bad. The service segment gross margin, however, is a stunning 87.5%. And the service segment grew at 20% this quarter, while the product segment actually fell by 4%. While a 4% drop isn't good, it underscores the shift in Fortinet's strategy. A shift away from hardware and to services. This shift is clearly laid out in Fortinet's investment materials. Did Wall Street simply ignore this? The hardware market for cybersecurity will grow, but the opportunity lies in services. As more IT departments shift their resources to the cloud, Fortinet will be there providing the software to secure it. And their software is mostly developed in-house, which accounts for their higher CapEx recently. This will result in organic growth versus growth via acquisition like their main competitor, Palo Alto Networks. The growth expected for services is nearly 20% annually for the near term. This is going to push the margins even higher and ultimately lead to more free cash flow for investors. So, how were the results in this quarter, and are they worth buying after the huge 23% pop post earnings? So here's the quick summary of the results for the second quarter of 2024. So the top line revenue was at $1.43 billion, which is up 11% year over year. However, that was driven by the service revenue of $982 million, which is up 20% year over year. And I believe this is one of a couple things that had Wall Street very excited. Their operating margin came in at 30.5%, a record for Fortinet. And the second part was this here. Billings and revenue were at the high end of their respective guidance ranges. And founder and CEO Ken Xie, he said, "We are continuing to execute our strategy to invest in the fast-growing unified SASE and security operations markets while gaining market share and secure networking." And more on that billings number. So the total billings were $1.54 billion for the second quarter, remaining flat compared to the same number from last quarter, year over year. But what's important there is Wall Street expected $1.52 billion. So they beat that Wall Street expectation, and Wall Street expected them to fall. They remained flat in a very strenuous market. They also maintained that billings guidance for the rest of 2024, showing Fortinet's resiliency in the market. And speaking of that guidance, they raised their guidance for revenue to $5.8 to $5.9 billion. The high end for 2024 from the last quarter was at $5.845 billion. They raised the high end of the service revenue, the more profitable segment, to $4.025 billion from $3.99 billion. And they raised the high end of the gross margin to 80%, up 200 basis points from the guidance last quarter at 78%. And they're really focusing a lot of investment on their services segment. So we should expect these margins to continue to grow over the long term. This was all in all an excellent quarter for Fortinet. They showed strength in their overall position in the market. They're showing that their investment in the services segment is working as they're growing that segment at 20% per year. They're showing that margin growth, and they're raising their expectations for the future. And if we look at their gross profit for the service segment, 1.685 billion. That's a gross margin of 87.5% year to date. That's up from 1.346 billion last year to date, which was an 85% gross margin. They expanded their gross margin by over 230 basis points. This is what has investors so giddy post earnings. It's almost like Fortinet hit that trifecta. They increased market share, they grew their margins, and they raised their guidance. And that's why we saw such a huge 20+% pop in the market. So Fortinet is foreseeing a 282 billion total addressable market by 2028. The information security part here, this is where their services segment, this is the part of the market they're trying to capture there. And you can see that that's projected to grow at 11.2% CAGR through 2028. Of course, with the investments that Fortinet is making, they expect to grow at nearly 20% CAGR through that time. However, that investment, it doesn't come without a cost. You can see the PP&E, the capital expenditure for year to date so far in 2024, is significantly higher than in previous quarters. They had 221.9 million in Q1 and 23.1 million this past quarter. That has hit their cash flow a little bit, as they had only 318.9 million in free cash flow in Q2. That is down from 438.3 million last year. But the other main reason the free cash flow was down a little bit in this quarter is they did beef up their working capital needs. You can see here they increased their accounts receivable, as well as this other line item here, which relates mostly to accrued liabilities. So they did beef up their working capital needs. So long term, I believe there's a lot to like about Fortinet. They're investing in the right places, they're increasing their margins, and they're generating value for shareholders. However, are they a good buy right now? Let's check out my investment summary. So here you can see those excellent results for Fortinet in this quarter. That 11% revenue growth, that 30.5% operating margin. So after last quarter, I was actually projecting that operating margin to be about 25%. Now it's tracking to about 29%. And the net income margin, I was tracking at about 21% last quarter. Now it's at nearly 25%. So Fortinet really did have a blowout quarter. The free cash flow projection is actually about the same as I had from last quarter, primarily because they are still making those significant investments and beefing up their balance sheet. So all in all, if you look here at my year one estimate for operating margin at 29%, I raised that from 25%. The 9.64% year one estimate now I have for revenue, I raised from 7.1% last quarter just due to the amazing growth that they demonstrated. I'm projecting revenue growth to be about 10.8% and an operating margin about 32% for the base case. The bull case, I have revenue at 12.63%, but only 14.75% for the next 10 years of service revenue growth. And it could be much higher than that. So even my bull case is quite conservative. This will ultimately lead to a free cash flow margin by year 10 of nearly 36% on the base case. And just for reference, they had a free cash flow margin of about 33% at the end of 2023 and 38% free cash flow margin on the bull case. So at the moment of this recording, Fortinet is trading in at $68.94 at about a 40.8 PE. Their forward PE is at 37.5. Both of these are much lower than their 5 and 10 year averages. For my bear case, I have a DCF price of $77.36. My base case price is at $95.19. My bull case is at $115.60. And for my exit multiple, I have a $74.11 price. My comps there include companies like Palo Alto Networks, VMware, ServiceNow, Checkpoint Software, and Qualys. So without any margin of safety, that's a buy price of $88.23. Of course, on the quality investor, we need that margin of safety. My preferred margin of safety for Fortinet is at 20%, just due to the riskier nature of this particular software business. With the new updated model here, it's at $70.58. This really was a blowout quarter, because that last quarter, my 20% margin of safety was at about $62. And you can see the very high quality metrics that Fortinet possesses. They have an incredible ROIC of 173%. Keep in mind, they're a very capital light business. Their extremely high margins help generate all of that operating income that lead to the high ROIC. And these margins, right now, the gross margin at 77%, this isn't updated for the latest quarter. So it's really at about a 79% right now. And the operating margin's closer to 26%. So this is a very good business fundamentally. And these margins are only going to increase because of that focus. And these margins are only going to get better because of that shift to the services segment, the far more profitable services segment. So we'll see what happens to that share price for Fortinet over the next few days. It may come down to the mid to high 60s. But either way, if it bounces around, it very well could be a pretty good buy right now. And of course, this is not financial advice, but remember, for the more cautious investors out there, we are in a bit of a weird market right now that could see some more weakness. Thank you for watching today's video. And if you've made it this far, go ahead and subscribe to the channel. Thank you and happy investing.